Family trusts come up a lot in conversations with high net worth Canadians. And almost every time, the person asking has heard the term, know it is something they should probably understand, but has never had anyone explain it in simply plain language. So that is what we're going to do here today. In this video, we're going to walk through what a family trust is, what it can and cannot do, when it makes sense for a Canadian family, the real costs and obligations involved, and how to have a productive conversation with your advisor about whether it belongs in your plan or not. So let's get into it. I'm Kris Dureau with Green Private Wealth. Our mission is to help Canadian families turn financial complexity into a clear, actionable plan so you know where you stand and how your future is protected. Let's start at the beginning, because the word trust gets used in a lot of different ways. A family trust in Canada is a legal arrangement where one person or entity holds and manages assets for a group of beneficiaries. There are three key roles in any trust. The first is a settlor. This is the person who creates the trust and transfers assets into it. In a family context, this is often a parent or a grandparent. The second is the trustee. This is the person or entity responsible for managing the trusts and assets and making decisions on behalf of the beneficiaries. The trustee has a legal obligation to act in the beneficiary's best interest. That can be the settlor, a family member, a professional trustee, or some combination. The third is the beneficiaries. These are the people who benefit from the trust assets. In a family trust, that often includes a spouse, children, grandchildren, and sometimes a family corporation. Now here's the key point. When assets are transferred into a trust, those assets no longer belong to you personally. They belong to the trust. That separation is what creates many of the planning opportunities we're going to talk about. In Canada, the most common type of family trust is an inter vivos trust, which simply means a trust created during your lifetime rather than through your will. Family trusts are governed by the Income Tax Act, provincial trust law, and the specific terms of the trust deed. Now that we understand what it is, let's talk about what it can actually do, because this is where the planning value is. The first thing a family trust can do is split income among family members. Historically, this has been one of the main reasons higher net worth families use trusts. The trust earns income, and the trustees may have discretion to allocate that income to beneficiaries in lower tax brackets, instead of all the income being taxed to the highest earner in the family. It may spread across multiple family members who each pay tax at their own marginal rate. Now, this is where we need to be careful. The Income Tax Act has tightened the rules around income splitting over the years. The tax on split income rules, or TOSI, can significantly restrict the ability to split certain types of income with family members who are under the age of 18 or not actively involved in the business. The rules have changed a lot over the years around this. So this is not a blanket strategy it once was. Whether it still works in your situation depends on your family's circumstances and how the income is generated. This is where qualified tax advice definitely matters. The second thing a family trust can do is multiply access to the lifetime capital gains exemption. If a family trust holds shares in a qualifying small business and those shares are sold, each beneficiary may potentially be able to use their own lifetime capital gains exemption against the share of the gain. For a family with multiple adult beneficiaries, that can shelter a very significant amount of capital gains from tax at the time of a business sale. For business owner families, this is one of the most powerful and practical uses of a family trust and what we see the most often. The third thing a family trust can do is provide asset protection, because the assets inside a trust are not personally owned by an individual. That separation can create added layer of protection in the right circumstances. For professionals, business owners, or anyone with a meaningful liability exposure, that can be valuable. The fourth thing is estate planning flexibility. Assets held in a family trust do not flow through your estate in the same way as personally owned assets. That can reduce probate exposure, avoid delays, and keep certain matters more private than assets passing directly through a will. The trustees continue managing the assets according to the trust deed, which can make the transfer of wealth more controlled and more flexible. And the fifth thing is intergenerational wealth transfer. The trust allows you to set terms around how and when beneficiaries receive distributions. You can build in conditions, timelines, and discretionary powers so trustees can respond to changing family circumstances over time. For families that want to transfer wealth thoughtfully rather than all at once, that can be a major advantage. So, who actually needs a family trust? Because they're not for everyone. And setting up one without a clear purpose, that's a mistake. The situations where a family trust most commonly makes sense are these. 1. You own shares in a qualifying small business and you're thinking about a future sale. If there's a realistic exit on the horizon and the business has meaningful value, the lifetime capital gains exemption planning alone can justify a serious conversation around this. And this is important. The trust usually needs to be in place well before the sale, not the week before you sign a purchase agreement. 2, use significant investment assets and adult family members in lower tax brackets. If the income splitting rules apply in your situation and there's meaningful income being generated, that may reduce the family's overall tax burden over time. 3, you have a complex estate and you want to avoid probate while creating more structure around how wealth passes to the next generation. This can be especially relevant for blended families, families with significant assets, or situations where beneficiaries may need professional oversight. 4, you have a child with a disability or a beneficiary who needs long-term financial support. A trust can provide ongoing managed distributions in a way that's structured, protected, and sustainable. 5, you're a professional or a business owner with meaningful liability exposure and want a more deliberate separation between certain assets and that liability risk. All of these that I just mentioned are situations where a trust usually deserves a real conversation. All right, next, now let's talk about what a family trust cannot do. This part matters just as much because there's a lot of misconceptions around this. Family trust is just not a way to make taxes disappear. Income earned inside that trust has to be taxed somewhere, either in the hands of the beneficiary or inside the trust itself, often at the top marginal tax rate. The value comes from the thoughtful planning and allocation, not from eliminating tax altogether. Family trust is not a simple or cheap structure to set up or maintain. It's a real legal and accounting commitment. If you're not going to use it properly, or if the tax and planning benefits don't justify the cost, probably not the right tool. A family trust does not guarantee protection against every creditor claim. There are rules around fraudulent transfers and the timing of asset transfers. If assets are moved into a trust after a liability has already arisen, that protection might not hold. And a family trust is not permanent. In Canada, trusts are generally deemed to dispose their assets every 21 years, which can trigger a capital gains tax event. This is known in the trust world as the 21-year rule. Without planning well before that date, the tax consequences can be significant. Okay, next section here, let's talk about cost, because that's something many people underestimate. The setup costs usually include legal fees for drafting the trust deed. That can range from a few $1,000s for a straightforward structure to much more for a complex one. There may also be immediate tax consequences depending on what is being transferred and how it is structured. The ongoing obligations are where the real commitment comes in. A family or trust requires its own annual tax return filed with CRA, which means ongoing accounting fees. Trustees also have fiduciary obligations. That means keeping proper records, making distributions in line with the trust deed, and acting in the best interests of all beneficiaries. If the trust holds shares in a private corporation, there can also be additional considerations around how the dividends flow through the trust and how they're allocated. Total ongoing costs for a family trust, including accounting and legal support, can easily run from $2,000 to $5,000 or more per year depending on the complexity. That is not necessarily a reason not to do it, but it is a real cost that you should be aware of, and it should be weighted against the actual planning value the trust is expected to create. The rule of thumb we use with clients is simple. If the planning benefit does not clearly outweigh the cost and complexity, the trust is probably not the right tool. But when a business sale is on the horizon, or there are significant planning opportunities, that cost may be small relative to the value being created. So if you think this might be relevant to your situation, here's how to have a productive conversation about it. The first thing to bring is clarity on your goals. Are you mainly thinking about a future business sale, income splitting, estate planning, asset protection? Your answer shapes whether a trust makes sense at all, and if it does, what kind of structure may be appropriate. Second thing is a realistic picture of your assets and income. A family trust creates value when the assets or the income flowing through it are substantial enough to justify the cost and complexity. Your advisor needs to understand what is actually going into the trust and what is the role it is expected to play. The third is timing. If you're thinking about a business sale, timing definitely matters. Trust planning generally works best when it is done well in advance. Earlier is almost always better. And the fourth thing is an openness to hear that a trust may not be the right answer. A family trust is a powerful planning tool in the right circumstances, but is not universally the right answer. A good advisor should tell you when it makes sense and when it does not. Family trust is not a magic tax elimination strategy. It's a legal structure that, in the right circumstances, can create real planning advantages for high net worth Canadian families. If this raised questions about how your own assets are structured from a tax standpoint, we've put together a free guide called Keeping More of Your Wealth, a modern guide to tax-efficient investing. It covers the strategies higher income Canadian families should be thinking about, and you can grab that using the link in the description below. Give this video a like if it was helpful, share it with business owners or a family member who has been wondering about this, and subscribe for more advanced financial planning content for Canadians. I'm Kris Dureau of Green Private Wealth. Thanks for watching, and we'll see you in the next one.